Well, good afternoon, everyone, and a very warm welcome to this press conference on behalf of the International Monetary Fund. Thanks especially to our colleagues at the World Economic Forum, and thanks to them, this event is becoming a little bit of a tradition at Davos, where we give the update on our world economic outlook. I am delighted that we have with us today the Managing Director of the IMF, Madam Kristalina Georgieva, who will be making some opening remarks. And we also have with us the IMF's Economic Counselor, Geeta Gopinath, just to my left, who will then offer more detail on the outlook. Geeta, of course, is also the Director of the IMF's Research Department. And next to Geeta is the Deputy Director of that department, Gian Maria Milesi Feretti. And Gian Maria, of course, is very well known to all of you. So with that, I will ask the Managing Director to kick us off, and then we'll hear from Geeta, and then we'll hear from you and to many colleagues who are online as well. Managing Director.
Well, thank you very much. Thank you all very much for coming. My gratitude to Klaus Schwab and the World Economic Forum for giving us a platform for this update. Those of you who were here last year are familiar with the format. It is a double act. I continue to follow my predecessor's tradition. I will provide the overview, and then our chief economist will give you all the important, very significant details. So let me start with the good news. After a synchronized slowdown in 2019, we expect a moderate pickup in global growth this year and next. We already see some tentative signs of stabilization. Recent data suggest that trade and industrial output are bottoming out, but we have not reached a turning point yet. Moreover, we are revising slightly downwards our October projections for 2019 as well as for 2020, 2021, and Geeta will give you the numbers as well as the explanation for this slight downward revision. The reality is that global growth remains sluggish, and when it is sluggish, this is on the way for countries to be able to boost incomes and living standards. And above all, we are all adjusting to live with the new normal of higher uncertainty. Yes, we have good news with the signing of Phase 1 trade agreement between US and China. But the underlying causes for trade tensions and the fundamental issues of reform of the trade system are still with us. And just in the very first weeks of the new year, we have witnessed increased geopolitical tensions in the Middle East, and we have seen the dramatic impact that climate shocks could have. We saw them in Australia as well as in parts of Africa. So in that context, while in October we were able to sum up the economic forecast, or our judgment on the economy in 2 words, synchronized slowdown. With my apologies to you, now it's a little longer. It is 4 words. Tentative stabilization, sluggish recovery. And I can tell you we spent a lot of time trying to compress this into 2 words. We are still in the beginning of the year. It is still a good time for New Year resolutions. So what is our advice to policymakers? What could they take for the year? Our first piece of advice is keep doing what works. What we have seen working is the contribution of accommodative monetary policy. The fact is that monetary easing has based on our assessment, added 0.5% to global growth. There have been 71 rate cuts by 49 central banks. This is the most synchronized monetary easing since the global financial crisis. And again, I want to stress it has delivered for the global economy. Just imagine if we didn't have this 0.5%, then we would have technically been talking about recession. But we are not. We have avoided that. However, we know that monetary policy is being used actively, cannot be the only way for the future to boost growth. We have seen some countries already using fiscal space, using fiscal measures, and taking me to the second advice to policymakers as a New Year resolution, we would say focus on boosting potential growth. And so when we are stressing boosting potential growth, we emphasize both a more systematic reliance on fiscal tools, as well as, very importantly, stepping up economic and financial reforms, lowering barriers to entry in service sectors, balancing the benefits and risk of fintech to boost the role of fintech, and concentrating on structural reforms in reskilling, upskilling, and so forth to boost potential growth. We are very keen to see more focus on building resilience in two aspects. One, resilience to potential financial system risks. You heard me, maybe some of you heard me talking about financial sector can play a role also in reducing inequality. Taking seriously climate risks and concentrating on building resilience to those risks and tapping into the opportunity a transformation to low-carbon, climate-resilient economy offers. We would like to be in an era when macroprudential tools are enhanced and their deployment expanded. Last but not least, be ready to act if growth slows again. Meaning, have in your portfolio projects that are ready to move if you need to boost your economy. And definitely be prepared, should there be a slowdown, for a more synchronized action, so a coordinated fiscal response can boost growth. Spirit of cooperation. This is why we are all here in Davos, to nurture that spirit. We have to take these New Year resolutions, not just for 2020, but for the whole decade ahead of us. In some ways, the beginning of this decade has some eerily reminiscent of the 1920s. High inequality, rapid spread of technology, and huge risks and rewards in finance. For the analogy to stop right there and go no further, acting together in a coordinated manner is absolutely critical. I want to finish with a quote from Tolstoy, from Anna Karenina. And the quote is, it's a beautiful quote, "All the variety, all the charm, all the beauty of life is made of light and shadows." For the future of the 20s, acting together, cooperating more, will bring more light, can dispel the shadows. And may that be our New Year resolution for the 20s, for all of us. Thank you very much.
Thank you very much, Managing Director. And we will now turn to Gita to offer a bit more detail.
And of course also to Gian Maria. I want the audience to notice that the IMF is very firmly committed to gender equality. So we have Gita and we have her deputy as well.
Thanks again, Managing Director. Gita, over to you, please.
Thank you, Kristalina. I plan to dig in a little deeper into the numbers and also give you a sense of where we think the world economy is headed. In the October World Economic Outlook, we described the global economy as in a synchronized slowdown with escalating downside risks that could further derail growth. Since then, some risks have partially receded with the announcement of a US-China Phase 1 deal and lower likelihood of a no-deal Brexit. Monetary policy has continued to support growth and buoyant financial conditions. With these developments, there are now tentative signs that global growth may be stabilizing, though at subdued levels. In this update to the World Economic Outlook, we are projecting a modest recovery in growth, for growth to increase from 2.9% in 2019 to 3.3% in 2020 and 3.4% in 2021. The slight downward revision of 0.1% for both 2019 and 2020 and of 0.2% for 2021 is owed largely to downward revisions for India. The projected recovery remains highly uncertain. It continues to rely on recoveries in stressed and underperforming emerging market economies, as growth in advanced economies are projected to stabilize at close to current levels. Now, there are preliminary signs that the decline in manufacturing and trade may be bottoming out. Now, this is partly from an improvement in the auto sector as disruptions from new emission standards start to fade. A US-China Phase 1 deal, if durable, is expected to reduce the cumulative negative impact of the trade tensions on global GDP by end 2020 from 0.8%, which we had calculated in last October, to 0.5%. The service sector remains in expansionary territory with resilient consumer spending supported by sustained wage growth. The almost synchronized monetary easing across major economies have supported demand and contributed an estimated 0.5 percentage point to global growth in both 2019 and 2020. In advanced economies, growth is projected to slow slightly from 1.7% in 2019 to 1.6% in 2020 and 2021. Now, export-dependent economies like Germany should benefit from projected improvements in external demand, while the US is forecast to slow as fiscal stimulus fades. For emerging and developing economies, we forecast a pickup in growth from 3.7% in 2019 to 4.4% in 2020 and 4.6% in 2021. Now, we have downward revisions of 0.2% for all of the 3 years. The biggest contributor to the revision is India, where growth slowed sharply owing to stress in the non-bank financial sector and weak rural income growth. China's growth, on the other hand, has been revised upward by 0.2% to 6% for 2020, reflecting the trade deal with the United States. Now, the pickup in global growth for 2020, as I mentioned before, remains highly uncertain. It relies on improvements in growth outcomes in stressed emerging markets like Argentina, Iran, and Turkey, and improvements in underperforming emerging and developing economies such as Brazil, India, and Mexico. Now, let's move on to the risks. Overall, the risks remain to the downside, despite positive news on trade and diminishing concerns of a no-deal Brexit. However, new trade tensions could emerge between the United States and the European Union, and the US-China trade tensions could return. Such events, alongside rising geopolitical risks and intensifying social unrest, could reverse easy financial conditions, expose financial vulnerabilities, and severely disrupt growth. Now, importantly, even if the downside risks appear somewhat less salient than in 2019, the policy space to respond to them is also more limited. It's therefore essential that policymakers do no harm and further reduce policy uncertainty, both domestic and international. This will help to revive investment, which remains weak. Now, monetary policy should remain accommodative where inflation is still muted. Now, with interest rates expected to stay low for long, it's very important for countries to proactively use macroprudential tools to prevent the buildup of financial risks. Given historically low interest rates and weak productivity growth, countries with fiscal space should invest in human capital and climate-friendly infrastructure to raise potential output. Economies with unsustainable debt levels will need to consolidate, including through effective revenue mobilization. Now, to ensure a timely fiscal response if growth were to slow more severely, countries should prepare contingent measures in advance and enhance automatic stabilizers. A coordinated fiscal response may be needed to improve the effectiveness of individual measures. Across all economies, a key imperative is to undertake structural reforms, enhance inclusiveness, and ensure that safety nets protect the vulnerable. The countries need to cooperate on multiple fronts to raise growth and spread prosperity. They need to reverse protectionist trade measures and resolve the impasse over the World Trade Organization's appellate court. They must adopt strategies to limit the rise in temperatures and the severe consequences of weather-related natural disasters. A new international taxation regime is needed to adapt to the growing digital economy and to curtail tax avoidance and evasion, while ensuring that all countries receive their fair share of tax revenues. So to conclude, while there are signs of stabilization, the global outlook remains sluggish and there are no clear signals of a turning point. There is simply no room for complacency, and the world needs stronger multilateral cooperation and national-level policies to support a sustained recovery that benefits all. With that, I will stop.
Thank you very much, Gita. And we're going to turn to your questions in the room. Please, may I ask, keep the questions short, and please identify yourself by affiliation. And we'll try and take as many questions as possible, both Gita and Gian Maria. I'm going to start, gentlemen, in the second row with your hand up. CCTV, I believe. Thank you, sir.
Yeah, Shen from CCTV. Question to Gita. So compared to 3 years ago, are you more optimistic or more negative for this year's growth for the world economy? And also for China, what's your expectation of China's economy for 2020 and how that will contribute to the whole world? Thank you.
I assume you meant compared to 3 months ago, not 3 years ago. Okay. Yes. So compared to 3 months ago, like as I mentioned, 3 months ago we were concerned that the risks were so large that they could further derail growth, and growth was already at the weakest since the global financial crisis. Since then, because we've had some positive news on the trade front and on Brexit, and strong monetary policy support and fiscal support in some countries, we are seeing signs of stabilization. So these are tentative signs, and we're seeing signs of stabilization. And again, overall, while there are downside risks, it remains less severe or less salient than it was 3 months ago. As for China, we expect China to slow slightly as the years go by. That's because of a structural adjustment that China has to go through with moving away from external-driven growth to domestic-driven growth. We did revise China up by 0.2% for 2020 because of the improvement in the US-China trade relations.
Thank you. I'm staying over here. The lady in the front, please. I think it's CNBC.
Sylvia Mato from CNBC. I would like to ask you about the risks that you mentioned. One of them is new trade tensions between the US and Europe. I was wondering what sort of probability do you assign to this scenario? And could you elaborate on the economic risks of new trade tensions between the US and Europe? Thank you.
So while we've had positive news with the US-China Phase 1 deal, there's obviously a lot more that still needs to be done. We would hope that the world moves towards a more open and sustainable trading system. We would hope that there would be a more comprehensive deal between the US and China as the months go by. But we are concerned about risks returning, however, on the trade front, both with respect to US and China, but also with respect to the US and European Union. And there are other countries in the world that are also using protectionist measures. So trade tensions and disruptions are something that we do put out there as an important risk.
Thank you. I'm going to take the second row gentleman with the hand up, blue sweater, Reuters. Thank you.
Balazs Karani from Reuters. Two quick questions. One is about car manufacturing. There seems to be signs that car consumption habits are changing. So even if the sector is rebounding, do you see a risk that traditional producers, particularly in Europe, will not benefit from this rebound? Second is about central banks and climate change, and whether you think central banks should, in fact, take a bigger role in fighting climate change. Isn't there a risk, if they do this, that this creates an impression that they are ever so powerful and they can solve any problem in the world, which is probably wrong? So wouldn't such a role actually mislead governments about the power of central banks?
With respect to the auto sector, 2019 was a year when we saw a shrinkage in the auto sector. Towards the end of 2019, and if you look at some high-frequency indicators now, you certainly see some signs of stabilization. That said, the auto sector is going through a transformation. There are shifts in preferences towards more greener cars, electric vehicles. And so we can think of countries that rely on demand from, say, China, that might be affected because the demand has shifted more towards electric cars as opposed to the more traditional fuels. And then there's also changing preferences in terms of using the more shared economy, things of that kind. So this is a sector that is in transformation. I mean, although we have the signs of stabilization at pretty low levels at this point. As for central banking and climate change, I mean, we see an important role where central banks are involved, which is with regard to stress testing. And that has to take into account risks associated with climate. And that's an important role that central banks can play.
Thank you. ITV in the front row, please.
Hello there. You mentioned in the outlook the risk posed by climate change. I wonder, though, in the IMF's view, are governments acting urgently enough to tackle the threat posed by global warming?
Climate risk is near and present. There are huge changes that will be associated with the change we're seeing in the climate. One is, of course, that we would see a transformation, a structural transformation in the economy as you shift away from traditional industries to kind of more green industries. And that transformation has risks in terms of jobs, in terms of it requires reskilling. Secondly, of course, there are the risks that are associated with how to deal with climate change right now. There are small states that have, been affected severely by climate change. The question is how to adapt to that. So this is not something that countries can actually argue about. It is a major issue. They have to step up, and they should display all the political will that's needed to get the job done.
Thank you, Gita. I'm swinging around to the side of the room, and El País here, and the lady in the front. Thank you.
Hi, thank you. Alicia Gonzalez from El País. Two questions. You revised downward for Spain, your outlook for Spain, and I would like you to elaborate a bit on that. And you mentioned several times in the report the risks associated to social discontent and the need for inclusiveness. Does it mean the IMF recommends now get back from austerity and use the fiscal policy instead? Thank you.
So with regard to Spain, we had a small downward revision. Remember, Spain was coming from cyclical highs, and it slowed down a little more faster than we expected. I'll ask Gian Maria to go into that in more detail. Let me just briefly comment on social unrest. Social unrest picked up quite sharply in 2019. You saw that in many parts of the world. There was no one common explanation for why it was the case. There were different reasons in Chile versus in Hong Kong. These were completely different reasons. However, it is important to recognize that social spending is well targeted, that the vulnerable are actually protected, and countries need to make sure that the growth and the recovery that we're actually projecting is shared more equally.
Yeah, maybe I can elaborate a bit on Spain. Spain had the revisions of national accounts, which came in right as our October WIO came out. And one of the consequences of that was to find that growth at the beginning of 2019 had been lower. And that translated into somewhat weaker 2019. The external environment has also been on the weak side. I mean, the euro area economy has slowed considerably, and for Spain, also Latin America, which is an export destination, is the region that is doing most poorly in the world economy, certainly for 2019. And so a weaker external environment and somewhat faster slowdown of domestic demand and the national account revisions are the factors explaining the downturn in our projection.
Thank you, Gian Maria. I'm taking the lady in the front, Heather Scott, the Washington Post.
Thank you. You say in the report countries with fiscal space should increase spending on initiatives to raise productivity growth and others. Can you specify which countries? Are you speaking about the United States, about Germany? Which countries do you think have ample fiscal space to do more?
So again, just to be clear, we live in a time with historically low interest rates, which means that there are countries that have projects that they can invest in that will pay off a positive return, given that they can borrow at negative rates. This would seem like the time to do it if you have the fiscal space. In terms of the countries that I would put in this category would be Germany and Netherlands, would be two countries where, given that there is a need for investment in the long-term potential of the economy, given the interest rates that we have now, from a pure cost-benefit analysis, there would be an argument to undertake such spending.
Maybe
Thank you.
Just
Maria,
one
please.
word.
Please.
Just one word on. So you asked about the United States. The U.S. has a large fiscal deficit to start with, quite large, despite the fact that the economy is at the record low unemployment. So that's a reason why, in terms of absolute level of spending, we're not recommending an additional boost, both for structural reasons because of the debt dynamics and cyclical reasons because the economy is at full employment. One country that is actively using fiscal space in 2020 that had it is going to be Korea, that had a pretty large slowdown because it's a country very sensitive to global trading volumes. It's a very open economy, and they're going to expand on the fiscal side next year.
Thank you. There's a gentleman been waiting patiently at the very back. Yes, sir. Hold on.
Sorry.
Yep. There you go.
The national newspaper in Abu Dhabi. My name is Mustafa Al-Rawi. Thank you. At the beginning, there was a mention of the impact of geopolitical risks in the Middle East region on the global outlook, and I wonder if I could have a bit more on that. And also, what does that mean for Middle East and North Africa growth for 2020?
So we've seen a rise in geopolitical tensions in the Middle East. We still have to see how far this goes. If you look at the response of markets and if you look at oil prices, the reaction has been fairly muted at this point. We've seen some increase of about $3 to $4 in the price of oil, but nothing very large. Of course, again, it's going to depend upon what shape the geopolitical conflict takes. What it does mean for us concretely is that in our current forecast, we've assumed the price of oil to be about $58 a barrel. For our October forecast, it will be somewhat higher by about $3 to $4. And if there's much more serious, prices could change much more dramatically.
Thank you, Gita. We have literally thousands watching this live. I'm going to take a few questions online. Just let me take this one right now, which is on India. And the question is, what changed so dramatically since December, I guess they mean since October, for you to downgrade the Indian outlook so substantially?
So in India, relative to the numbers we had projected in October, there was the first 2 quarters of the fiscal year 2019-20 came in much weaker than expected. And an important reason for this is stress in the financial sector, particularly in the non-bank financial sector, and because of which there's been a sharp slowing of credit growth. In addition to that, there was weak rural income growth, and that has also affected domestic demand. Now, in the case of India, we are projecting a recovery in the next fiscal year, 2020-21, and that should come from the monetary stimulus that's been put in the system, and some of it from the corporate tax cut.
Thank you. Let me go just down the middle here. Yes, sir. Gentleman in the second row. Please put up your hand, sir. Thank you. Yeah.
Thank you very much, Mr. Rice. I'm Cameron with CCTV Business News Channel. So with the 2020 US election ramping up, trade tension could come back between China and the US, despite the signing of Phase 1 deal. So in that case, how much fiscal and monetary room is left for China? Should it deploy a stimulus package? And would that be concerning to the world?
So if things were to get, if China were to slow more sharply than what we have a very small gradual decline, we do see a greater role for fiscal stimulus than for monetary policy stimulus. I'm just going to hand over to Gian Maria if he wants to add more on.
Yeah, well, if you think in reverse terms, we have revised the forecast for China up 0.2%, but our calculations suggest that the Phase 1 trade deal is more beneficial than that to the Chinese economy, but China is going to do a bit less stimulus because the trade tensions have gone down. So conversely, should the trade tensions rise, we would expect the authorities to try to sustain growth, including, and in that, under those circumstances, again, as Gita just mentioned, we think a fiscal lever and on budget and transparent is a more effective way to address the issue than monetary stimulus, given the need to reduce financial vulnerabilities.
Thank you, Gian Maria. Thank you for keeping your questions brief. We'll try and take as many as we can. I'm going to stay down the middle with the gentleman right here in the front. Right here in the front, please. Thank you.
Thank you very much. Jorge Valero with El Economista. Question coming back to the trade tensions between the EU and the US. If the dispute worsens, in particular with the car tariffs, do you expect that that could be enough, that would be sufficient to bring the EU into a recession?
I don't wish to speculate at this point because we will have to see if and when this does happen, what the particulars look like. So it's just very hard to speculate. I mean, it is important to flag that the growth in the euro area is at the low end, and so shocks of this kind can certainly have serious negative consequences.
Thank you. I'm staying down the middle. This gentleman's been very patient in the third row here. Thank you, sir.
Thank you. Hrvoje Krevšić on One Television Croatia. What is the outlook for Central and Eastern European economies? Will these economies be able to be engines for growth for the rest of Europe, as they were not long ago, or do they also face certain risks? Thank you.
I mean, they're certainly on average doing better than mainland Europe, but we could give some more detail.
Yeah. They've actually been surprisingly resilient, I'd say surprisingly, because we know how integrated in the supply chains in Europe these countries are, and trade has slowed down dramatically in 2019. Yet the growth rates of countries like Poland and Hungary have surprised, if anything, on the upside. So that is good news. Now, down the road, some of the factors that have been favorable may not necessarily persist as much. Labor force growth has been helpful not because of demographics, which are very unfavorable, but because you had a lot of migration. For example, Ukrainians in Poland. How long that is going to last is of course a question. And obviously, these countries are not immune to a more persistent slowdown in global trade, given that they're very, very open economies. So challenges remain, but I would say overall, in the picture of a pretty bleak 2019, they've been mostly a bright spot.
Thank you. I'm swinging back round to the right. And Financial Times, please, right at the end.
Chris Giles from the Financial Times. Gita, you said that we need a new international tax agreement. At the moment, it seems like the US is suggesting that any agreement should be voluntary on its companies. France, Italy, the UK and others are suggesting they go it alone. What is the way to have an international tax agreement that is acceptable to all?
We believe it's important for this to be a multilateral agreement that is multilaterally enforced. And by that we mean not just the advanced economies, but it does have to bring in the developing economies too, because any such reform will have implications not just for advanced economy tax revenues, but also for developing economy tax revenues. I mean, there's no doubt that this has to be addressed. It is important, given that it does have important effects on the tax revenue base of countries. But we do wish this to be something that's multilateral, both in terms of the design and in terms of when it's implemented.
Thank you. Lady on the right there with your hand up. Yes, you've been very patient. Thank you.
Good morning. Giuliana Ferreino, Corriere della Sera. Unlike last year, you haven't mentioned Italy among the potential risks to global growth. And in fact, you raised the growth for 2019 to zero, to plus to 0.2 as opposed to zero projected in last October. How do you see Italy despite, so you sound a bit more optimistic. How do you see Italy despite its huge political uncertainty? Thank you.
So with Italy, we do have an upgrade, but the numbers are still quite small. I think it's 0.2% for 2019. There's been, because of the easing in monetary conditions around the world, financial conditions have eased everywhere, and Italy has benefited from that. Of course, Italy still needs important structural reforms to raise its potential growth. Gian Maria, would you like to add anything?
Yes, I think market conditions have changed quite, as Gita was mentioned, quite dramatically. I mean, we're talking about interest rates on 10-year yields 200 basis points lower than they were towards the end of 2018. That makes a big difference. The thing is that market sentiment can shift, so it is important to address the underlying vulnerabilities. That is, gradually bringing down the high public debt through a sustained medium-term consolidation effort. And of course, you act on the numerator, but it's essential to act on the denominator of the ratio of debt to GDP and hence take measures to boost potential growth. The forecast that we have, 0.2, 2019, 0.5 and 0.7 for the next 2 years is very, very modest growth. Italy needs higher productivity growth. Its GDP per capita is way lower than it was pre-crisis. And so really an emphasis on boosting potential growth is really important.
Thank you. I'm going to try and take people who've been patient. Yes, sir, in the front row.
Hi, Kamarul from Esrawani, Malaysia. What about trade tensions and wars between developing economies like the palm oil weaponization of trade, for example, between China, India, and Malaysia, and the East Asian countries, if they come together, can that mitigate any risk coming, for example, the Southeast Asian nations of ASEAN?
So it is indeed the case that protectionism has risen around the globe, and this is not all about just a few countries. It's more broadly true. There have been the temptation to use tariffs to respond to any kind of disagreement. And of course, this has important consequences for growth. I think this is why it's just all the more urgent that countries first agree that this is not the best way to respond to disagreements, and also to fix what needs to be fixed about the world trading system. We obviously welcome all regional integration, that there is a need for more regional integration around the world, and that can absolutely offset some of the risks coming from trade tensions in other parts of the world.
Thank you. Lady Wei at the back, thank you for your patience.
My name is Diabo Seto for the South African Broadcasting Corporation. I'm noting muted or flat growth for sub-Saharan Africa at 3.5% for this year, and these are the projections, of course, and next year. I'm more curious about your optimism with South Africa's growth at 1%, actually from 0.8% for Africa's most industrialized economy. What is informing your optimism for South Africa?
I mean, our numbers for South Africa are 0.4% for 2019, 0.8% for 2020, and 1% for 2021. These growth rates are lower than the population growth rate in South Africa. So in terms of per capita terms, these are, these are the numbers we would hope would be much better. The growth would be much higher than this. In the case of South Africa, there is still elevated policy uncertainty, tied to the slow pace of structural reforms, and that has been weighing on growth. And because there's now limited fiscal space, public spending is now weaker than it could have been, and these factors are having an impact. Would you like to add anything, General?
Yeah, I think. One more obstacle to growth are really these supply bottlenecks. I think the most obvious one is the frequent power outages. Those take a really heavy toll on aggregate supply. So you have both an impact on real activity, and you have the financial woes of Eskom weighing on the fisc, on the budget, and hence curtailing room for other productive public spending. So it's essential to get, the public enterprise reform to be effective and to improve the functioning of key ones like Eskom. That has been one clear factor at play during 2019.
Thank you. We'll take just a couple more. Yes, sir. You've been very patient. Right in the front row here, please.
Thanks, Mr. Rice. I'm Daniel from Brazil's Valor Econômico. We've seen a slight improvement in the forecasts for Brazil in 2020. Could you elaborate a bit more on that, and especially what should be the main priorities and challenges after the Brazilian pension reform?
So yes, we have an upgrade for Brazil, and I think two important drivers of that were the pension reform, but also the significant monetary policy rate cuts that have both helped growth in Brazil. I mean, going forward, of course, the challenge remains very high and growing debt levels in Brazil, and so there would have to be more reforms on the fiscal end with respect to, not just pensions but wages, and I think that would probably be an important priority for Brazil.
Good. Let me take the Wall Street Journal here in the second row. Can you raise your hand, Greg? Thank you.
Two quick questions. First of all, can you comment on whether impeachment is going to have any effect on the U.S. or global outlook? Second question, given that central banks acted across the board to ease last year, how much closer are we to completely running out of ammunition on the monetary front, and how worrisome is that?
So Greg, on the question of impeachment, I don't really have anything for you. On monetary policy easing, I mean, this is the point I wanted to make, which is that though it looks like the risks are less salient than 2019, the space is also more limited than 2019. That said, of course, not all central bankers are in the same place. I think in the U.S. there's obviously still rate cuts that are possible that get you closer to the 0% mark. There is now increasing evidence that forward guidance and quantitative easing actually do have a useful effect on the overall on net terms, have a positive effect on the economy in terms of growth. And of course, those instruments still remain for other parts of the world too. But that said, I think it's important that if things were to get growth were to slow more severely, fiscal policy would have to play a more important role. And it might be useful to think now of some kind of a cyclical fiscal rule so that if and when things go worse, that the response in terms of spending is a little more automatic than it was the last time around.
Thank you, Geeta. I'm going to finish with the lady here in the third row.
Thank you, Jenny Leonard from Bloomberg. Can you elaborate exactly on the Phase 1 deal, how much this deal added to the improved global sentiment for global growth, and if the Phase 2 deal or Phase 3 or whatever comes after this never materializes, what is the impact?
So before taking into account the Phase 1 deal, we had projected that the negative impact, the cumulative negative impact on the global economy of the US-China trade tensions, and this is cumulated from 2018 to end 2020, would be to shave off 0.8% from the level of global GDP, right? So that's a cumulative 0.8%. With the ingredients of the US-China Phase 1 deal, particularly the fact that some tariffs did not come about, which were expected in December, and some mild rollback, we are reducing that 0.8% number to 0.5%. And since the Phase 1 deal happened now, we think most of that improvement, about 0.2%, is basically what's helping growth in 2020. Now, this is already in our forecast, so it's not that it adds anything to the number we have, but it's what has gone into supporting the growth in 2020.
Thank you very much, Geeta. Thank you, Gian Maria. And thanks to all of you for being here today. We appreciate your attendance and your questions. And we look forward to seeing you in Davos over these next few days. Thanks very much.